Hello and welcome to Virtual Investor Conferences. My name is Bob Power, and on behalf of OTC Markets, we're very pleased you've joined us for our next live presentation from Southern Energy Corporation. Before I introduce our speakers, a few points to note. Please submit your questions in the question box to the left of the slides. If you're interested in scheduling a meeting with Southern Energy, please click on the Meetings tab found on the left navigation bar. You'll be able to view the company's availability and submit a meetings request. On a final note, all of today's presentations will be recorded and available for 24/7 replay. At this point, I'm very pleased to welcome Ian Atkinson, President and CEO, Gary McMurrin, Chief Operations Officer, and Calvin Yao, Chief Financial Officer of Southern Energy, which trades on the OTCQX Best Market under the symbol SOUTF and on the TSXV under the symbol SOU. Welcome, Ian, Gary, and Calvin.
Thanks very much, Bob. We're excited here this is our first presentation we've done in this format for the OTC listing, which is new for us. So happy to be here today. One thing I will point out, the presentation we're using is based off our November corporate presentation, so a little bit dated. We will have an update on our website in the next few weeks, probably early April, that will have all of our new disclosed information. But we can jump right into it here today, and hopefully we'll have some questions along the way. So as you pointed out, we are listed on the OTCQX, the TSX Venture, and also the AIM market of the London Stock Exchange. And we are very focused on consolidating and developing natural gas assets in the Gulf Coast of the United States. You can see the map inset here on the first slide, and it highlights the states of Mississippi, more central Mississippi, northern Louisiana, East Texas. And we've owned and operated our current assets for almost 7 years. Most people don't know that. The first almost 5 years was as a private company, and we've been public here for the last few years. We stayed very focused in this area for two main reasons. The first being commodity pricing, specific to natural gas. And as you compare Henry Hub pricing where we are, it is usually a premium to other basins in the U.S. like the Texas market or the Appalachian market because of the pipeline suppression they have there. And I have a slide coming up on that. It actually shows how where we are producing gas, we're now getting even a premium to Henry Hub. The other reason we've stayed focused in these areas are the type of conventional assets, so large-scale assets with low recovery factors currently. And it's because of the shale gas revolution, as we call it in the United States, where a lot of these companies in the last 10 to 15 years have been very focused on the various shale basins and developing those. And there has been a complete ambivalence and undercapitalization of conventional assets here where, they still are very sizable and scalable, but simply had not had capital spent on them in the last 10 to 15 years. A couple of highlights on the company on the right-hand side. These are Q3 numbers. We were just over 3,400 BOEs per day. At that time, our market cap was $97 million, just under $100 million. Currently, we've like the rest of the markets here with the price of gas have come down. Our current market cap is about $50 million. One thing we pride ourselves on, though, is alignment with our shareholders. Board and management own 7% with our direct cash investments in the company, and we like that as a lot of our main shareholders obviously do as well. Business plan in one slide is quite simple. There's two main pillars of growth here. Obviously, the inorganic is the drilling. We have, and we are in the middle of a program right now, which we'll refer to today. We have a deep inventory of organic growth opportunities, but we also do look at acquisitions and consolidations in our focus area, which is kind of highlighted on the map on the left. And the crux here is to continue growth through high and low parts of the commodity price cycle, which we can see now it's come down substantially since Q4. But both of these pillars of growth are to build something large scale and sustainable. And more importantly, in this Gulf Coast area, where now, as the U.S. has shown, they are grabbing significant market share in LNG export and getting their gas to a global market. Highlighted some recent activity, and I referenced a little bit of this already. When we first started this company, obviously differentiating ourselves from, for example, Canadian producers. We're headquartered in Western Canada. but even different basins in the U.S. where we said that, we attracted Henry Hub pricing at our wellhead, which was a differentiator. And now we've seen something even better than that, actually. And where we sell our gas into is a pipeline system called Transco, and specifically Zone 4, where starting kind of late summer last year, we saw a basis premium arrive here. And we had not seen that before historically. And in Q3, it was high as $4 above NYMEX pricing. Right now, it's about 30 or 40 cents, but we do see it continue out in time, 2 or 3 years. And I think that is now even more of a differentiator for us and where we are producing our gas. We are in the middle of a capital program. We did a raise late last summer, last fall, to kick off a 13-well development program at one of our assets called Gwenville. And this was on the heels of what we considered a very successful 3-well appraisal program back in Q2 and Q3 of last year, where we drilled the first 3 horizontal wells in this asset in, I think, 12 years since the previous operators. The board at that time approved a $100 million budget, which was to fund this through our cash flow and credit facility expansion. We are obviously looking at how we execute this program, given where the price of gas has come, and I see that was one of the questions. So we're in discussions with our board of directors right now on what makes sense from this capital program. But I will say that we are currently just finishing drilling our 7th well of the 13-well program. We have completed the first 3 wells on one pad, and may leave 4 wells, at least 4 wells, uncompleted right now to complete at a later date when the price of gas is more supportive. But we can handle those again further in the question period. This slide I'll hand over to my Chief Operating Officer, Gary McMurran, who we looked at this and we're actually kind of surprised ourselves, to be honest, with comparing our netback and our cost structure to some of the biggest gas producers, frankly, in the U.S. and in Canada, and how we compare on a netback basis. So I'll let Gary talk to the next few slides here on this, and then through the description of our Gwenville asset, which we are currently capitalizing in the field.
Thanks, Ian. Yeah, we like to highlight the strength of our assets and obviously the jurisdiction we work in. And this bar chart really does a good job of that. It's based on Q3 public numbers from really the sort of who's who of gas players in North America. U.S. names, these are names like Comstock, Chesapeake, EQT, Coterra, large companies that typically produce over a BCF a day. And the red bar there is the average NYMEX pricing from Q3 at about $8.20. You can see Southern achieved a sales price of $10 per MCF, and further to what Ian spoke about, that premium based on where we're selling our gas. Now, the lower part of those bars, that's an all-in lifting cost. And, when we did set out to compare ourselves to these companies, we assumed that because of their scale that they would have, economies that we surely wouldn't, given our size. But you can see that most of these companies have an all-in gathering, processing, transportation cost well in excess of $1 per MCFE. In Q3, we were about 64 cents per MCFE. And that really does speak to a couple of the things. One, that we own our own infrastructure, so we're not paying a midstreamer to process and get our gas. And then the other one is to get our gas to market. We are at the market. In the case of Gwenville that we'll talk about today, we have 2 interstate pipelines that run right through that asset. We are tied into one of them, so there is no additional transportation cost, to sell our gas. So that really is the strength of this asset. As we look to develop it, we can see downward pressure on our all-in lifting costs down into the 40 to 50 cent per MCFE range, at which point we basically become top of class. And so this really does speak to the high margin nature of our assets. In North America, this is some of the highest margin gas that you can produce. Talk a little bit about our asset base today. I get pretty excited, but given the time constraints here, I'm going to have to keep this pretty tech light. We do control close to 30,000 acres of net land right now in central Mississippi. Really important to note that this is all held by production. And so, Ian spoke to our sort of buy low, drill high strategy. If we decide to pause our drilling program, we have no issues like expiries or commitments. We can truly drill when it makes sense to drill, to do so. So unlike some of the other resource plays where they are chasing expiries and drilling commitments. So a unique advantage there. We've talked upper right-hand corner there about our very low lifting costs on a BOE basis under $4 or around 70 to 80 cents per MCFE right now. We don't have any production concentration risk like some companies would outside of our new large horizontal wells that we're drilling now. But that's how we now expand the asset base. A lot of the investors that we speak to are quite unfamiliar with the history of oil and gas in Mississippi. Suffice it to say, though, that in the lower 48, it is one of the most prolific producing states historically. Over 10 TCF of gas has been produced and over 2 billion barrels of oil. And the only reason that you may not be familiar with it is because a lot of this production started back in the 1930s and 40s when some of the super majors, Shell, Gulf, Humble, which is now Exxon, got their start in the state of Mississippi. And one interesting fact too, on a per well basis, it actually has superior production to its neighbors, Louisiana and Texas. Some very prolific fields, prolific wells in the state. But what is interesting is this bar chart on the bottom middle there, right through to roughly 10 years ago, the state 200, 250, 300 wells were being drilled year on year, active development in the state. And then you see that fall right off to next to nothing. And that coincides with what Ian introduced, this idea of the shale revolution. And all of the majors, especially the ones I spoke to here, right around that time exited the state looking for their 500,000 acres of land in the nearest shale basin. And Mississippi is devoid of a commercial shale play. And so all of that technical horsepower, all of that capital has been gone for the last 10 years. And that's what really sets up the opportunity for a company like Southern to come back to some of these conventional and quasi-conventional assets that have had none of this new technology that we've developed through the shale plays and apply it to these immense resources. So very excited by the opportunity that sets up for the company. I'll speak to Gwenville. It's just one of a few assets where we have organic development identified. It happens to be dry gas, which is why it has risen to the top here. It's very quick and easy to get on production versus some of our higher liquids content plays that we will look to develop here in the future. Historically, actually, Gwenville is Mississippi's largest gas field. It's produced over 1.5 TCF of gas and 12 million barrels of oil to date. On the right-hand side there, you can see a stratigraphic or a depth chart of where all of that historic production has come from. And what's really important there is how many productive horizons there are. Upwards of 10 horizons have produced in the past. And, if you look to the middle of that chart, the Tuscaloosa, that was sort of the big elephant zone that the majors found back in the 1940s. But I would characterize the zones below that and above that as having very low recovery factors. And that's where a company like Southern comes in to take modern technology and apply it to this known resource. And so we talk about very asymmetric risk to reward. We've got proven production from numerous zones. And we've been able to quantify, and I'll point out the two shallow formations that we're drilling right now, the Selma Chalk and the City Bank. We've identified over a TCF of remaining recoverable gas in place within our own infrastructure, our roads, our pipelines, our compression, our processing. So we don't need to step out like they do in the shale plays, continuing to spend capital above ground on facilities and infrastructure. So we truly take our capital and apply it to basically our drilling and completion operations. So some of the most capitally efficient production that you can add. And again, we've got a long history here. You can see the map on the bottom left. Hundreds of wells have been drilled in this field. We've taken all of that data and really quantified it. We have a 3D seismic program. You've got, especially in those shallow zones in the Selma Chalk and the City Bank, where a lot of those wells have been drilled. You've had a very successful early development vertically. Then EOG, which is one of the previous operators who started development of this field back in the 2000s, really when gas prices took off the first time, they came in and started drilling what we term Generation 1 horizontal wells in the field, and had great success, off the back of the early vertical development. And unfortunately, they left the state, in search of the Eagle Ford oil window back in 2010. And it had been essentially a dozen years before anyone had drilled a horizontal well, with modern technology, when we came in last year for our appraisal program. So quick comments on that. On the right-hand side is a pretty picture of that 3D that EOG left us with. Effectively, anything that is not blue on this map, we'll be looking to redevelop with horizontal drilling. You can see where all of the old verticals are, all of them productive, and then where that early stage development of the horizontal drilling began. The 19-3 pad site is what we drilled last year as our 3-well appraisal program, and I'll touch base on where we're at in the current program. The cartoon on the bottom left gives you a picture too. We're talking about significant drilling inventory and a massive structure, over 36 square miles in size. But we're also targeting 3 different formations to drill horizontally. Our appraisal program focused on the upper Selma Chalk. We are extremely excited to be testing our first lower Selma Chalk and Citibank wells as part of this program. And very important, from a net asset value perspective, our Citibank is completely unbooked from a reserves perspective in horizontal wells. So we do see years of reserve growth, in addition to what we've already accomplished, here in the years to come with these other formations. Our program to date, Ian mentioned that, roughly $100 million program, which involved drilling up to 13 horizontal wells in the field. We started with the 18-10 pad. It spud back in November. So 3 wells there, 2 upper Selma Chalk, and our first Citibank test. Then the rig skidded over to the 14-6 pad to the west. We drilled another upper Selma Chalk and our first lower Selma Chalk test. We're currently drilling the 13-13 pad that is just to the southeast of 14-6. And we have altered it. It is going to be 1 Citibank and another lower Selma Chalk test. So that rounds out to that 7 wells that we're contemplating, putting a pause on the program at here. And again, very important, depending how many wells are completed and then when, this year, according to, gas prices, tremendous upside in the lower Selma Chalk and the Citibank as we look to add those reserves to our upper Selma Chalk that, have been appraised and proven last year. Last slide for me here, dealing with economics. Obviously, the chart at the bottom shown different levels of economics between $4 and $7 gas. At $2.50, we're roughly where we are today. Strip obviously moves up quickly in time, but we would hit the go button on development. At roughly over $3, $3.25, we start to get reasonable rates of return. What I've shown here too, it's important to note, they're based on what we term Generation 2 well results. Because of our disclosure rules in the UK with our AIM listing, we're only allowed to show a type curve that has been proven, not what we expect from these new modern horizontals that are longer and have higher frac density than what was previously done. So these results, these Gen 2 wells of 4,500 foot laterals, an IP30 of 5.7 million cubic feet per day, and an EUR of 4.3 BCF. Those are from technology of 8 or 9 years ago, and these are the actual averages of what they achieved. So we're quite excited and confident that our new modern design will improve upon these figures, and highlighted by our 19-3 number 2 well from the appraisal program last year that had an IP30 of 6.5 million cubic feet per day. So we've already shown that we can achieve a superior deliverability to what's been done in the past. And I'll hand things back to Ian here to talk to where this sets us up for the future.
Yeah, thanks, Gary. So we'll try to leave some time for questions here. But this is what growth looks like for us in our base assets. So this does not include any acquisitions, and why we always have been telling our investors and potential investors the scale we have in our assets. So simply, this is driven off those Gen 2 type curves that Gary mentioned from 10 years ago, and drilling 15 wells per year in our Gwenville asset, which was essentially the program we were kicking off here until the gas prices fell away on us. And two things here. Obviously, you get to a very substantial size of production quite quickly with these wells. A couple different ways we could look at expanding this or accelerating this. One is drilling 15 wells per year is actually only 6 months of drilling, which there's no reason to stop drilling. That at the time we had put this development plan together, it was about over 6 or 7 months ago, when certainly market cap and cash flow was different, and it made sense in that context. If we drilled simply all year round with one rig, I think we would drill in excess of 20 to 25 wells, which would accelerate that growth. Also looking at, and there's no time today, but some deeper formations in Gwenville where we get into some liquids-rich gas in a formation called the Cotton Valley. There's a couple other assets we have outside of Gwenville called Williamsburg and Mechanicsburg that is also liquids-rich Cotton Valley gas, and we could add a second rig into those assets potentially when prices recover. So all these assets, as Gary mentioned, are held by production. We own them almost 100% working interest, certainly our operator on all these assets. So have a lot of versatility here to accelerate and expand growth in the correct price environment. Now, I do want to spend 10 to 30 seconds here on acquisitions, because we obviously acquired our base assets back in time, which I see as one of the questions we have here. And a workflow in one of our previous companies, I think really did build a lot of that early shareholder growth. The company was called Athabasca Oil Corporation. We started with $100 million of capital and did a $3 billion joint venture with PetroChina, and then eventually an $8 billion capitalization at a go public event. I think a lot of the early value there was how we did our technical work. And just simply in this map, we've shown a fairway here of focus. We have over 25,000 digital well logs. So simply there, we can, and as we are driving our acquisition strategy, we can, ahead of any of these assets coming to market, fully evaluate these assets from a technical standpoint, know which assets fit together, which assets have organic growth within them, because our strategy is only to buy producing assets which have development opportunities. And I think we can stay ahead of the curve here, and this is certainly a corporate advantage for us as we want to make acquisitions. So we don't wait for assets to come to market. We can simply drive this process ourselves, and having been a previously private equity-backed management team, a lot of the assets, for example, in northern Louisiana are private equity-backed. And so we have an inroad into a lot of these companies for conversations, et cetera. So that's why we feel this is still going to be a big part of our corporate strategy go forward, on top of all the organic growth that Gary's been talking about in Gwenville. I thought we'd spend maybe 1 minute on the price of gas too. It's very volatile, which we've seen, and we kind of split this into three different discussions: short-term, medium-term, long-term. Short-term, certainly we've seen the volatility where gas prices were $7 or $8 in Q4, as low as $2.50 here recently. The balance of 2023 is about $3. Three things had to happen in our view for gas prices to fall. Was simply no winter weather, which we've had, I think, one of the warmest winters in the southern U.S. in 100 years, from what I've read. We had to have some unprecedented production growth in Q4, which we did, but that was completing wells that were drilled years prior, so not a sustainable growth. And also have the continued delay of that Freeport LNG export facility restart. It's supposed to be on in December, and then January, and then February. So all three of those things kind of manifested together. Now, if you look at this reversely, Freeport is back online, and the expectation is fully shipping its nameplate of 2.1 BCF a day by, call it May 1st. It's already shipping, I've read, anywhere between half a BCF and 3/4 of a BCF a day right now. Production is not growing the way it was. It's certainly, you see some of the budgets coming out from these big public companies. I don't think you can see much in the way of growth from the production standpoint. Weather still remains to be seen, but I think summer weather can be more of an impact, as we saw last year, where we had extreme heat in July and August, and NYMEX pricing rose up to $8 or $9. Very similar setup right now to where we were last year. But when you look to the medium term, starting here at the end of this year, the U.S. will be adding essentially 3 BCF a day per year for the next 3 years of new LNG export capacity. And there's obviously projects planned beyond that, but I think that's where you really start to see the longer term case for natural gas being at a higher price for longer. And then beyond that, we see where these LNG ships are going to either Asia or Europe. And price convergence is a topic of discussion. I think you could see that convergence with European or Asian pricing once we have excess LNG export capacity in the U.S., meaning there's more export capacity than domestic production. And then these LNG exporters almost become ambivalent to price up into where the shipping, the liquefaction, and regasification costs are. So I think medium to long term is very robust for gas prices, and the next 10 years will be nothing like the last 10 years, with the U.S. being now, I think, having the biggest market share of LNG export. In the short term, I think we're still subject to and at the mercy of weather, but I think we're starting to work our way out of that with what I just mentioned. So last slide here is just more of a summary. So the company strategy is certainly to grow. We're a growth company. We have 2 main pillars of growth. One is organic growth through drilling. One is inorganic growth through acquisitions. We're in one of the best parts of North America, frankly, but certainly U.S. as far as pricing. We get a premium to even NYMEX pricing. And I think where and when you execute your business plan is very important. And being in that Gulf Coast area with the vast amount of conventional assets to consolidate and redevelop at the same time as we are, I think, getting into a more structural positive price environment for gas is why we're excited to be here talking to you today about our company. So we've left a few minutes here for questions, and thank you for everyone for their attention. Calvin, maybe you can read off some of these questions. I think we've handled one of them, but let's just go through them if you could.
That one, we're anticipating releasing those the week of April 17th. Another question is, how did you acquire your assets in Mississippi?
Yeah, maybe I can handle that one. We've made 2 acquisitions in the past year, one in 2017, one in 2019. As Gary mentioned, our base assets in Mississippi were previously owned by EOG. We bought the assets from a private equity-backed company. And then the other balance of our acquisition was from a private operator in Mississippi.
Thoughts on your valuation and catalysts for re-rating?
Yeah, we've looked at this, and our capital markets success last year. We were actually the top energy performer on the TSX Venture Exchange, and have done a lot of work with trying to gain market awareness. I think the summary of that is we still trade on where natural gas prices go, and so I do think we're undervalued right now because the price of gas is suppressed for, I think, a short period of time here. It does not affect the overall growth profile we have and the low risk redevelopment kind of growth chart I showed you previously. And I think right now undervalued in the market, even where our current cash flow is.
We have a question here. Can you speak to shareholder returns? Any plans for buybacks or dividends?
Not at this point. We're going to focus on growth. We have no pressure from current investors to become a dividend-paying company or buy back shares. Not to say that doesn't change in the future, but for right now, we're focused on growth. And I think for us to get to that 25,000 BOE per day range we put out there publicly, whether it's 10 to 20,000 in that time frame, you become a more of a going concern company that gains a broader market focus. And so I think our focus will be on growth until that point. Looks like we're kind of running out of time. If there's any follow-up questions, please use the email address on this last slide here. And I would like to thank everyone for their time.